You got to be very careful when it comes to the most beaten down tech and e-commerce stocks in this environment. The vast majority of these things are simply too risky, even if they've come down substantially from their highs and you get takeover bids like we had this morning. We've learned painfully over the last 12 months that they're the definition of what doesn't work when the Fed's tightening. So let's not fight the tape at every single point. But there are always exceptions. See, for instance, last Thursday, I highlighted 4 e-commerce names that had risen substantially from their lows. I talked about Etsy, Pinterest, I did that again this morning, Shopify, and Mercado Libre. That's the South American one that I like so much. Well, I do believe in Etsy and Pinterest more than the 2 others. The fact is, all 4 stocks were behaving like they'd already bottomed. They're putting up some solid numbers. I think they'll look a lot better once the calendar turns to 2023. They start facing easier year-over-year comparisons, and maybe the tax loss selling will finally end. And that's why we call them the comeback kids. Originally, though, I wanted to talk about 5 of them, not 4. We ended up leaving one out. The 5th one is Chewy, because it was reporting that night, and I thought it'd be irresponsible to recommend it without taking some time to go over the quarter. That's not the way we do it on Mad Money. I'm not trying to guess a quarter, okay? I'm trying to think long-term about a stock. And I am glad we didn't jump the gun. See, last Thursday night, the online pet food retailer reported a confusing set of numbers that caused the stock to really whipsaw. It opened down 4%, and I said, oh, man, am I ever glad I didn't recommend this one. And then it only reversed and finished up 4%. Now, after taking the weekend to do some homework, I think Chewy's initial sell-off was a mistake. The stock very much deserved a rally, and it's exactly the kind of comeback play that should be worth speculating on at this point in the cycle, particularly because pets remain, even after COVID, a much sought-after thing as part of people's home. Part of that's because the stock's already spent the better part of 2 years in the doghouse. Chewy came public back in June of 2019 at $22 per share before jumping nearly 35 on its first day of trading. That was an exciting time, right? That actually held it back a bit because back in 2019, Wall Street still cared about things like overvaluation. We weren't fully in speculative mania mode yet. But after pulling back to 20 and change when the COVID crash hit in March of 2020, Chewy caught fire as everybody realized that an online pet food store would be a huge pandemic winner. Remember you saw the boxes next to the UPS trucks? I mean, I was like, oh, geez, I got to own this one. The darn thing charged all the way from $20 to $120 at its peak in February of last year, where it got a boost from the meme stock craze because Ryan Cohen, the Wall Street Bets messiah, who became the chairman of GameStop, was originally the co-founder of Chewy. Now, that said, he has no relationship with Chewy anymore. They don't even talk about him, man. I got to tell you, I tried. Said, hey, how about teams? Said, oh, I don't want to talk about that guy, which I think is actually a very good thing because I don't want any association with GameStop here other than to be attacked personally in the mentions column of Twitter, which I love so much. At any rate, after peaking in February of last year, Chewy spent the next 15 months moving lower. Like so many other COVID winners, its stock peaked well before the rest of the market. And the darn thing kept falling. It plunged all the way back to 22 and change in late May, wiping out nearly every penny of its gains since it came public 3.5 years ago. We know Chewy got a boost from the pandemic, but at its low, the stock was trading like this growth business had just been sitting on its hands for nearly 3 years, and that's not true.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.